Hello, I'm Eric Pettway, Chief Investment Officer at Journey Advisor Group. Welcome to CIO Corner. Last week, U.S. financial markets hit record highs. The S&P 500 rose 1.9% and the NASDAQ 100 gained 2.2%. Why are markets so strong? Three main reasons. First, earnings. Third quarter earnings are stronger than forecast. FactSet reports S&P 500 earnings grew 9.2% year over year in Q3, marking the ninth straight quarter of growth. This beats the original forecast of 7.9%. Second, rate cuts. The Fed is in a rate-cutting cycle, and this is an important tailwind for the markets. Third, strong market seasonality. The period from October to January has historically been the strongest season for owning the S&P 500 based on data from 1950 through 2024. This week, investors will focus on the Fed meeting, tech earnings, and the upcoming meeting between U.S. and China for new data to support the market's continued upward trend. The Fed meeting announcement on Wednesday is highly anticipated. Markets expect a 25 basis point cut with possible further reductions this year. Powell's press conference will be reviewed for policy changes. Tech earnings are expected to lead this season with strong reports and optimistic guidance anticipated. Markets hope U.S.-China trade talks will yield more agreements and fewer tariffs. Just this weekend, we had positive news in the trade talks, and the markets are up strongly today. Now it's time for a chart of the week. International equities, including developed markets such as Europe and Japan, as well as emerging markets like China and India, represent a vital component in constructing a well-diversified portfolio. While U.S. equities have delivered strong returns in recent years, incorporating assets from various regions can mitigate portfolio risk and enhance exposure to distinct economic cycles. Key considerations include international markets currently present relatively attractive valuations compared to U.S. equities, which remain at higher PE multiples. As of last Friday, the EAFE index, which tracks the developed market performance, has appreciated approximately 28% year to date, while the MSCI Emerging Markets Index was up 33% for the year. Also to consider, currency fluctuations may influence returns for U.S.-based investors. Specifically, a weaker U.S. dollar can enhance the value of forward holdings as underlying currencies appreciate. One other item to consider, emerging markets potentially offer superior growth prospects relative to developed economies, but they are subject to increased regional and geopolitical risks, resulting in elevated volatility. The chart shown here highlights performance trends among developed market equities across recent market cycles, underscoring their role in geographic diversification, even as they have lagged U.S. equities over the past decade. Maintaining diversified exposure across regions and asset classes continues to be a fundamental principle for achieving long-term investment objectives. We hope the CIO Corner and the chart of the week are helpful in these uncertain times. If you enjoy JAG's content, follow us on LinkedIn or your preferred social media channel. If you have concerns or want to review your portfolio, contact your JAG team to discuss your goals and stay on track. And remember, remain calm, stay focused, and most importantly, stay the course.